Welcome to our CFP Exam Prep podcast. Today, we're diving deep into a crucial tax concept that often appears on the exam: worthless securities and their tax implications. Let's break down this complex topic and ensure you understand the key points for your exam success. When securities become completely worthless, taxpayers can claim a capital loss deduction. The critical element here is understanding when this loss can be claimed. The IRS allows taxpayers to deduct the loss in the year the security becomes worthless, and importantly, sets the artificial sale date as December 31st of that year. Let's understand what makes a security worthless. A security becomes worthless when it has absolutely no value, not just when it has declined significantly. This typically happens in cases of bankruptcy or company liquidation. Many candidates make the mistake of assuming a major price drop qualifies as worthlessness. For example, if a stock drops from $100 to $1, it's not considered worthless because it still holds some value. Here's a practical example that often appears in exam questions. Imagine an investor holds shares in TechCorp, which declares bankruptcy in March 2023. The shares become completely worthless in July 2023. The investor can claim the capital loss on their 2023 tax return, and the IRS treats this as if the securities were sold on December 31st, 2023. A common trap in exam questions involves the timing of worthlessness. The loss must be claimed in the year the security becomes worthless, not when the investor discovers it's worthless. For instance, if a security became worthless in 2022, but the investor didn't realize this until 2023, they cannot claim the loss in 2023. This is where many test takers lose points. The tax treatment of worthless securities follows the same rules as capital losses from actual sales. For individuals, these losses can offset capital gains and up to $3,000 of ordinary income per year. Any excess loss can be carried forward indefinitely. This concept frequently appears in calculation questions on the exam. Another critical point that exam questions often test is the distinction between worthless securities and abandoned securities. While worthless securities are treated as being sold on the last day of the tax year, abandoned securities are treated as sold on the date of abandonment. This subtle difference can change the tax year in which the loss is deductible. When studying for this topic, focus on identifying the exact year of worthlessness and understanding the artificial sale date concept. Remember, the burden of proof lies with the taxpayer to demonstrate that the security became worthless in a particular year. Documentation of bankruptcy proceedings or liquidation events can serve as evidence. Let's conclude with a key exam strategy. When you see a question about worthless securities, first identify the year of worthlessness. Then automatically think of December 31st of that year as the sale date. This mental framework will help you avoid timing mistakes that could lead to incorrect answers. These concepts may seem straightforward, but they require careful attention to detail. The CFP exam often tests these principles through scenario-based questions where you'll need to determine both the timing and the tax treatment of worthless security losses. Master these fundamentals, and you'll be well prepared for this type of question on exam day.